What is exactly an income statement? Why it is considered so important in order to understand the business? And which are the most relevant elements to screen for when reading it? Today, we're going to be delving into the world of finance and specifically into an essential document, the income statement, which is vital for any investor, business owner, or anyone who would like to understand a little bit more about the business of a company. Also known as a profit and loss statement or P&L, it is one of the key financial statements used by companies, be it a small business or a multinational corporation. The income statement provides a detailed look at the company revenues, costs, expenses over a period of time, usually a fiscal quarter or a year. But let's start from the top. The income statement, in fact, begins with revenues, often referred to as the top line by the analysts. This includes all the income generated by the company from its operation. It could be from selling products, providing services, or any other type of primary activities that the company engages in. After we have identified our total revenues, we move on to the cost of goods sold, or COGS in jargon. These are the direct costs that are associated with producing the goods or services that a company sells. This includes things like raw material and labor cost. By subtracting the costs from the revenues, we arrive at what is called the gross profit of a company. This gives us a basic idea of how profitable the company's core business activities are. But this is just a very rough indication. In fact, this is called gross profit. There are still, in fact, some other revenues we need to consider. Those are the so-called operating expenses. These are costs that are not directly tied to the production, but that are essential for running the business. This includes, for instance, things like rent, utilities, marketing expenses, salaries of the non-production staff, and much more. When we subtract the operating expenses from the gross profit, we land to the operating profit, also known as operating income or EBIT, earning before interest and taxes. This is a key figure as it shows us how much a company makes from its core operation before accounting for interest and taxes. The next step involves first considering any interest income and expenses the company has incurred, which give us the profit before taxation, and then accounting for taxes. Once we have done that, we arrive at the final line of the income statement, the net income. This is also known as the bottom line, as opposed to the top line we have seen at the very beginning. This is the amount of money the company has earned after all costs, expenses, interest and taxes are taken into account. This is usually published as the earning per share or EPS, which is basically the total amount of profit after taxes divided by the number of shares outstanding. So now you might be thinking, why is the income statement so important? Well, by studying the income statement, we can assess a company profitability, understand where its expenses are going, and make informed decisions about investing, lending money, or working with the company. However, keep in mind that while the income statement provides important information, it does not give us the complete picture. It should be used always alongside the other financial statements to form a comprehensive understanding of a company's financial health. And this brings us to the end for today's video. I hope this gives you a clear understanding of what an income statement is and how to analyze it. Remember, understanding these financial statements is a key skill in the world of business and investing.